Varun Loshab, Head Institutional Research at HCFC Securities, joins into the show right now. Varun, hi, good to have you on the show. Varun, clearly everyone's waiting with bated breath for that upcoming rate rationalization of GST, which is, it seems that it's been, in the making for quite some time now, and now it's picking up steam. Having said that, the government also seems to be preparing for the worst when it comes to the U.S. tariff situation right now. And, clearly improvement exists on that front as well. India-China relationships as well improving. You've seen continual DII participation. And to think of it, we're not too far actually from that all-time peak at an index level. What is it that you're making of the market texture right now?
Yes, I think, quite a lot of moving parts, as you said, the positives and the negatives both are playing out. So, the way we are seeing things on the earnings front, first of all, this quarter, which just went by, we saw around 10% YOY earning growth, which was possibly the best in the last 3 quarters in terms of the YOY growth. And we believe next couple of quarters also will continue to see, double-digit earning growth on a YOY basis, partly due to the favorable base. And if you look at some of the large sectors like BFSI, IT, and even consumption, we believe earnings has more or less bottomed out. While there may not be a very sharp V-shaped recovery, but, at least things will incrementally get only better in all of these 3 sectors. So in that context, I think on the earnings front, we are not overly negative. We are not going back to a 15-17% earning growth period, but a 10 to 12% earning growth is clearly doable over next 3 to 4 quarters. In terms of valuations, we are still a bit on the higher side, which makes us believe that the room for PE expansion is not there. Maybe some PE contraction is still possible, which means that our returns from the market are going to be in single digit. But as you said, we are only 5-6% away from the all-time high. So, it's quite possible that we see, a new high in the markets by FY26 end. However, not to say that, things are going to get very euphoric from there, given the upside room is limited. But we are not overly bearish now. Like last 12-18 months, we have been sort of negative to cautious on the market, given valuations and earnings catch-up which had to be done, and this impending slowdown which was pretty much visible in terms of earnings. But now, while things will not get significantly better on the earnings front, but at the margin they will improve, and valuations also with market staying range bound for a year have improved a little bit. So in that context, we believe now risk reward is more balanced, and you can get a 7-8% kind of a return over next 6 to 12 months on the markets.
So Shrishti also joining in. Good to hear that you're not overly bearish at this point in time in the markets, but help us understand which themes are you bullish on? Because specifically with respect to the GST push likely, which sectors do you believe could be the biggest beneficiaries? Because I believe in your earnings review, you have highlighted that the autos, consumer discretionary, home improvement, they have led to the downgrades. But do you believe it offers a case for a re-rating post this news flow?
Yeah. So in terms of sectors, financials, we are positive now. We believe the worst of the NIM compression is behind. In terms of beyond financial, even consumer discretionary, we have done more constructive, and even consumer staples and autos, which were underweight, are now close to neutral in our model portfolio. So the overall consumption basket, you can say that from underweight position 6 months back, we are now more or less neutral on that space. And industrials and real estate, which we were quite sort of significantly overweight in our model portfolio 12 months back. We have progressively cut it down, though we still like select industrials and real estate stocks, but now not across the board positive in that space. So now it's, I think, from a more than sectoral, we believe it's going to be very stock specific from here on. It's bottom up stock picking in each sector, which will determine whether, how your portfolio does, because the sectoral calls and overall market call will add little value given, the levels at which we are.
Right, Varun. Want to get your sense on the entire cement and paint space in particular. Lots of price volatility here, but the biggest trigger that could be working out for these sectors going ahead is the potential cut in the GST slabs from 28%, where they are at present, to lower. Do you think this kind of push is enough for something like a cement and paints to start picking up again?
I think, see, the price elasticity of demand is not very high for some of these sectors. So I don't think you will see a significant sort of uptake in volume just because of GST rate reduction. But in case of cement, clearly we believe that there is a bit of pricing lever which the industry has, given the price hikes have been quite muted over last 5 to 6 years. And improving sort of lower prices because of GST cuts will give the headroom for the industry for the next 2 to 3 years in terms of ability to take price hikes in case there is any RM pressure or even otherwise. So in that context, cement is slightly more preferred compared to paints in our model portfolio. On paint sector we are still not overly bullish, but cement is a preferred sector now from our next 12 to 18 months perspective.
Nice. Varun, where within the healthcare and pharma space do you find opportunities? Because many of these stocks are already sitting, at least within the healthcare space, at their all-time highs.
Yeah. So healthcare, we are still positive. While you are right that stocks have run up and valuations are stretched, in certain cases, not as attractive as what they were 12, 18 months back, but something like Apollo Hospitals is still among our top picks in this entire healthcare space, and it continues to be part of our model portfolio. There are triggers beyond just the earning growth out there in form of demerger value creation. So Apollo, even, Max Healthcare, we have a positive rating. So I think definitely healthcare looks better than pharma at this moment, but even in pharma, we do have, select opportunities like, Torrent, Alchem, where we are still positive. Sun Pharma, we are still positive despite, some potential overhang from this whole tariff thing. But overall, I think healthcare is slightly better place to be than pharma from a next 6-month perspective.
For the next 6 months, Varun, if one were to really keep just that as a time frame, and hopefully all the uncertainties around tariff are going to be resolved by then for sure, where is it that you see meaningful earnings upside with all the government push, be it on rate rationalization when it comes to GST, or for that matter, even the push that one has seen from the central bank in terms of the easing of the rate cycle as well?
See, I think you have to keep in mind one, there in terms of earning expectation, like for FY27 now, our bottom-up number for around 250 stock coverage, which we have, is already close to 14-15%, which is pricing in a recovery in consumption and IT to an extent to happen for that number to come through, and even in the banking sector. So, I think the GST rate cut and all is not going to add to earnings straight away, because this has to be passed through to consumers. And as I said, the price elasticity is fairly low for certain categories like staples and all. For some of the discretionary categories, there would still be price elasticity. And therefore, out there could be some positive surprises on earnings. But at an aggregate market level, we don't see a big sort of a scope for earning upgrades, to come through because of this. But I think you have to look at the fact that these 2 or 3 events, the income tax rate cut, the GST rate cut, will help to finally revive, the consumption side, which was, looking quite weak. And for that 6.5-7% GDP to come through over next 2 to 3 years, government alone could not have done the heavy lifting in form of public capex. So I think this step may not have an immediate near-term earnings uptick, but from a 2 to 3 year perspective, it provides you that visibility on that low teens earning growth for the market to continue. And that should help keep the valuation multiples intact for the market.
Okay, interesting. Varun, great chatting with you on the show. Thanks so much for your time.
Same here. Thank you.